mix what I like, what I like, what I like, what I like. All right, what's up, world? Welcome to another edition of I Mix What I Like Live. Again, I'm Jared Ball, happy to be your host. imixwhatilike.org for all of this content and much more. Please make sure you're subscribed there because, again, across all the multimedia work that I and my colleagues do, you don't want to miss any of that beyond just these live streams. So please make sure you're signed up over there. And of course, at I Mix What I Like for all your relevant social media. Please do like, subscribe, and share, and consider becoming a member to this channel. And thanks to those who have already done it, including some new members even today. And we'll continue to talk more about what we would like to see happen with that membership. Again, it's not just about personal, well, enrichment is probably too strong a word given the amount and size we're talking about, but it's not about personal accumulation, which is, I guess, a kind of a nice segue to the conversation we're going to have in a moment. But it's about building a media collective and or supporting political prisoners and the people doing work around them. So we don't want to forget any of that. So please consider, if for no other reason, signing up on that basis. But at least like, share, subscribe, and so on the channel, and particularly this conversation. I did want to say, we're not going to get into it right now, but obviously the elections in Georgia have a lot of people's attention. And I just want to suggest that people, and I've already put the link in the YouTube channel to this conversation, check out Jackie Lukman's conversation about that just from a few minutes ago with Lukman Nation. In many ways that summarizes whatever I would have to say about it, and I would just encourage that you check that out as well. So, all right, that said, a couple of weeks ago I saw in a conversation, a discussion on his channel, that is Professor Richard Wolff, Democracy at Work, his economic update, and he mentioned briefly mentioned a report from our next guest that was published describing the liquidity crisis in major banks. And the reporting specifically in question is titled Liquidity Risk at Large U.S. Banks. And the author is Professor Laurence M. Ball, no relation, at least that we're not aware of. And what Professor Wolff just simply raising in passing was, well, if the countries and worlds, at least among the world's biggest banks, are in their own financial crisis, what does that really say for the state of capitalism? And then more broadly, what does it mean? More specifically, I would say, rather, what does that mean for working people here in the United States? And then even more particularly, I might want to ask, what does that mean for Black and brown working people and others in this country? So I looked up the report. I read the report. It is, when I reached out to our guest, it is above my economics analysis pay grade. And gets into some details that I really couldn't explain or break down, but does raise a couple of questions that I thought would be of great value to our audience and certainly to my own edification. So I reached out to the good professor. He was willing to join us. And so in just a moment, I'll bring him up, but I just want to let you all know that he is Professor Laurence Ball, who is a professor of economics at Johns Hopkins University up the road here in Baltimore, down the street from where I am at Morgan State. He is also a research associate at the National Bureau of Economic Research, through which this paper is published, and a consultant for the International Monetary Fund. He has previously been a visiting scholar at a number of central banks, including the Federal Reserve, the Bank of Japan, the Bank of England, and the Reserve Bank of New Zealand. His research topics include unemployment, inflation, and fiscal and monetary policy. And he is the author of The Fed and Lehman Brothers, Setting the Record Straight on a Financial Disaster, which came out on Cambridge University Press in 2018. I'll welcome him to the program. Professor Ball, thank you for joining us, and good afternoon.
Good afternoon. I'm very happy to be here. Yeah, and as far as I know, we're no relation, but maybe if you have a lot of money you're going to leave or something, I'll do some genealogical research.
Something tells me, given your bio, it would be the other way around.
I don't know.
But So what I did was I pulled out a couple of clips from the paper you published, and that I thought, and I would read the, 3 block quotes that would get us started one at a time and ask you to respond. But whatever we don't get to, please just bring us there, and that I think will at least get us started. But before we get to those specifics from your report or your paper, I did want to start with some of the broader questions, maybe for some of us and some of the more lay members of our audience. I think there's a lot of confusion around this and maybe even some disagreement. But from your perspective, I'm wondering, how would you start with a description of, before we get to this crisis of big banks, what are banks and what function do they play in, this particular society, but society in general, or capitalist society in general?
And actually, before answering the question, let me say this is really great to be able to talk to a somewhat broader audience than I usually talk to a very narrow set of economists. So
Sure.
Looking forward to some interdisciplinary dialogue. But
and vice versa. Most of us read some of the reports, some of the journalism, and hear pundits talk about economics, but we don't often speak directly to the people doing creating the studies themselves. But anyway, sorry.
So the basic idea of banks is fairly simple. They at least when things work well, their job is to get money from savers to investors. So if I'm thrifty and I have some savings, it doesn't do any good just under my mattress. So I put it in the bank, and then the bank is good, we hope, at finding, say, good investment projects, firms that want to expand and create jobs and produce things. And they get my money, and then I earn interest, and everybody wins from that. That's the basic idea. Now, the big Wall Street banks have expanded to do lots of other things. They also serve as brokers and dealers, helping people buy and sell securities. They invent new kinds of securities. They just do a lot of investments with their own money. They're sort of investment funds. And they have a number of roles sort of at the heart of the financial system. Trillions of dollars flows through them every day, which, getting a little ahead of the story, is why it can be such a problem for the economy if that suddenly breaks down.
Okay, very good. Thank you. And then going from there, you started to sort of touch on that, but what is the relationship then between the big banks that you're focused on in this paper and smaller banks, and even businesses beyond?
Well, smaller banks are more specialized. I mean, that's really the traditional idea of a bank that takes deposits and makes loans, and that's what they do. Small banks do that. Bigger banks do these other roles as brokers and as creating new securities and as helping firms issue stocks and bonds. Also, they have different kinds of lending. Things like credit card operations, where the big economies of scale, the big banks do. And the local bank would be more likely to lend to local businesses where they know the local economy and the local business community.
All right. And then I think lastly here I have, what role do the biggest banks play, and why, which you sort of just addressed, but why then is their being in crisis of particular concern?
Right. So it's complicated. It's again, a lot of money flows through people borrowing and lending and getting money to fund businesses. So just at the broadest level, it's almost, thinking about a canal or something where water is, pipes where water is flowing, or wires where electricity is flowing. And if it sort of breaks down at the center, that disrupts a lot of things. And there are a lot of spillovers. I mean, at any given moment, a big bank, owes people other banks hundreds of billions of dollars, and is also owed hundreds of billions of dollars. And if suddenly one bank gets in trouble, then all the other banks that lent the money get in trouble. And there's also just a huge psychological effect. I mean, this is getting a little, I assume things you want to talk about. The banking system is subject to runs. And do people still watch It's a Wonderful Life at Christmas time with Jimmy Stewart?
I don't know. I know that honestly, it's one of my wife's favorite films, but I don't know how popular it is, more broadly speaking, but it does actually address.
Yeah, it's a heartwarming Christmas movie, but it also, right, it has a bank run, and actually a very nice illustration of if people just, if there's a rumor about a bank, people lose confidence, suddenly everybody wants to withdraw their money at once, and then there's a big crisis because banks can't get back all the money they've lent out all at once, and really the what happened in, say, the 2008 financial crisis and what happens in banking crises are really just like, sort of like bank runs, Jimmy Stewart's bank, but scaled up to trillions of dollars, where people, and here it's not depositors withdrawing money, but the banks have all borrowed billions and billions of dollars in short term, for short terms, and if people lose confidence and cut that off, then they can get in trouble very quickly. And then also there's a big psychological effect, that if when Lehman Brothers got in trouble, everybody thought, well, if Lehman Brothers gets in trouble, maybe Goldman Sachs will be next, or maybe Morgan Stanley will be next, and you can very quickly get to a panic that disrupts the whole financial system.
Yeah, I mean, because even with smaller and sometimes bigger businesses on a daily basis, just even to cover their own payroll, they've taken loans from a bigger entity. So everything is moving and then going down, even with computerized investments, down to what, the nanoseconds or milliseconds of investments. So literally every moment things are changing. Money is being moved, capital is being invested, interest rates are going. So there's a lot of, right. So if one piece gets interrupted.
Yes, I mean, just to give one concrete example, maybe that'll make it, will illustrate it. In 2008, there was a crisis, the money market funds. So money market funds buy commercial paper, short-term bonds issued by firms. And there was one money market fund which had bought Lehman Brothers commercial paper. And then when Lehman Brothers got in trouble, they lost money. And that led to a big panic, and people pulled their money out of money market funds. And that set off a chain reaction, because money market funds buy commercial paper. So ordinary businesses, I'm a tire manufacturer in Ohio. To meet my payroll, I issue commercial paper, and the money market funds buy it. So when the money market funds didn't have any money, they didn't. That was one of the ways it spread to the non-financial economy. They stopped buying commercial paper, and suddenly I'm the tire manufacturer. I have nothing to do with Wall Street, I didn't think, but now I can't issue my commercial paper. I can't meet my payroll. Oh my goodness, I got to lay off workers. And then of course there's a whole snowball or multiplier effect, and then the workers lose their income and they don't spend at the local stores, and it spreads through the economy.
All right. So, okay. So with that little quick basis, I want to, read these three one at a time and have you walk us through some of this at least. Because honestly, after the first, I think, 7 to 10 pages, there's a thick portion of the middle there where I was really struggling to hold on with some of the details you were wanting. So, but you say here, quote, and by the way, if I didn't already, I'll link to this in the description of this video, but I might have forgotten to do that. Anyway, you said here, quote, specifically, I argue that the LCR stress scenario understates three types of cash outflows: withdrawals of retail deposits, losses of secured funding, such as repurchase agreements, and collateral calls under derivatives contracts. The scenario also overstates the level of cash inflows available to offset outflows. So obviously, if you could elaborate on what any of that means, and maybe start a little bit with what the LCR stress scenario is and why you have an issue with it.
Yes, yeah. So it obviously can get pretty technical pretty quickly, but the basic idea, again, think about bank runs where people lose confidence in a bank and withdraw their money. Although when we're thinking about a big Wall Street bank, think about other banks that are lending at money that suddenly cut off their lending. But it's the same basic thing, that suddenly the cash the bank has to operate has disappeared. What banks try to do is they basically try to hold liquidity reserves, basically hold either cash or assets that are very liquid. And very liquid just means you can sell them very quickly to get cash if you need it. So a Picasso painting might be valuable, but it's not very liquid, whereas a bond issued by the US government, they're traded every minute. So it's just like having cash. So the idea is to hold enough liquid assets to get you over a crisis. And the regulation, which was adopted, it was part of coming from the Dodd-Frank Act of 2010 to try to prevent future crises. It basically says that the principle is that banks have to hold enough cash or very liquid assets so that they could survive a crisis for 30 days. So even if everybody panics and says, we're not going to lend, I don't know, I'll pick a name just arbitrarily, Goldman Sachs is, the sort of most glamorous name. I have nothing against them in particular, but, there's some rumor, something's wrong with Goldman Sachs. Everybody abruptly stops lending to them to the extent that Goldman Sachs has some deposits that they get withdrawn. The idea is to have enough cash reserves to survive for at least 30 days. And 30 days is actually a long time in the sort of timing of financial crises. It's really, if you look at Lehman Brothers or Bear Stearns, they had problems for a while, but within 2 or 3 days, they went from, we're going to be okay, we're managing, to just out of business just overnight. Again, because sort of runs are so, it's once people lose confidence, there's this immediate stampede. Anyway, so the idea is to have at least 30 days reserve, and that would give the people in the bank and the Federal Reserve and regulators time to try to work something out. Again, if you read the 2008 crisis, Lehman Brothers learned, we have no money, we have 6 hours to declare bankruptcy. And I've learned a little bit, not very much, but a little bit about bankruptcy law. Doing a bankruptcy planning, that's a big deal. And this was, by far the biggest. So, basically the failure was chaotic, because there were literally just a few hours to try to plan it, and they were shut down. Anyway, so the idea is to give enough time for a more rational, maybe we can slowly wind down the firm, maybe somebody else will buy them, maybe. Anyway, but then long story short, what the regulation says, the key thing is how much cash do you need to survive for 30 days. So there are complex set of assumptions that you use to calculate how much cash will flow out. And the basic idea of the paper is that they are, too optimistic or not as pessimistic as they should be, given how bad a financial crisis could be.
Because from the big banks' perspective, their incentive would be to be constantly investing, lending, in the global economy. So they don't want to hold on to anything as much as possible, right? And if I read your paper right and even understood what you just said correctly, they would be thinking, I don't want to wait 30 days. If a crisis can kill us in 3, we don't need to have 30 days worth of coverage. Maybe we can think in our minds we could really get away with only 5 because we're not, a crisis we wouldn't survive 30 days anyway. So why would we need that much coverage? So let's invest, and come up, ride that line a little bit more. Is that is?
Yeah, sort of. I think. People running banks don't want the banks to run out of cash and go bankrupt, but they do. It's a trade-off. So that you're exactly right that when they have money, they want to lend out the money or do something with it to earn profits. They don't want it just sitting there as cash or U.S. government bonds that don't earn very much. So, so they're trading off how close to the edge can we push it, how much, and what they, I guess to use economics jargon, the problem is there's an externality. So there are costs and benefits of the bankers of having more or less liquidity. But there's also the fact that if there's a financial crisis, that does great damage to the whole economy. So it's like a standard, if a factory is thinking about how much should we spend on controlling pollution or preventing accidents or something, their costs and benefits for the company, but then there are big effects on the rest of the world that they don't necessarily have an incentive to take full account of.
All right. Okay. Let me read this next one that I pulled from your paper here. You say, quote, each of the large banks, and I believe you're talking about here the large ones that you're sort of assessing here, the big 5 or 6, as I think it was.
Yeah. So it's pretty much household names. It's Citigroup, JP Morgan Chase, Wells Fargo, Bank of America, Goldman Sachs, Morgan Stanley.
Right. And you say, quote, each of the large banks is a financial holding company that makes investments and owns subsidiaries that operate various businesses. These subsidiaries include commercial banks that take deposits and make loans. They also include broker-dealers that serve as financial intermediaries, buying or borrowing securities from clients and selling or lending them to other clients. Some of the broker-dealer businesses include prime brokers serving large investors such as hedge funds, and some include retail brokers. So there's a lot that I would want to ask you just about those few sentences, but one of them is honestly, I was struck by the line, and I'm not sure even in my own criticism of banking that I've thought of it in quite this way. But anyway, the line where you refer to these banks as financial holding companies. I don't know that a lot of people, even when talking about those biggest institutions, are thinking of them quite in that way. I think, the word bank suggests something very different, or is meant to suggest something very different than I think the word company. But as you go on in that statement that section I just quoted from, it seems like you elaborate on that a little bit, and I'd like you to elaborate even further. What does it mean that that these banks are financial holding companies as opposed to what we might popularly conceive of as a meaning of a bank?
Yeah. So a financial holding company is basically a company that owns other companies. I mean, it's a company that has subsidiaries, and theoretically they're separate. They're separate corporations. So Citigroup, for example, is a financial holding company. So Citibank is a bank which is owned by Citigroup, but then Citigroup also has other subsidiaries that do other things, and also they have they have banks or other operations in different countries. And it's a complicated, for my book, I looked at Lehman Brothers very, very carefully. They had something like, I don't know, maybe 30 different corporations or businesses that were all owned by Lehman Brothers, the holding company. And that, by the way, is interesting. To some degree, the division into different subsidiaries is done for legal or accounting reasons, and really you can think of it as being one integrated business. The trouble is when you start having bankruptcies, each individual unit is a corporation that goes bankrupt separately, and that further adds to the chaos. There were, after the Lehman Brothers bankruptcy, there were, huge hundreds of billions of dollars lawsuits between different parts of Lehman Brothers suing each other, about who owed who money. I'm not sure they're exactly answering your question.
No, I think so. I mean, because again, sort of what I think I'm trying to get at is that well, for instance, there's, specific to my own narrow interests and work is that there are ideas among certainly among that are encouraged in Black communities, but I think across a number of poor communities, that banks either have as a primary function or can have as a primary function the ability to create wealth and prosperity for those communities themselves. And I think that fundamentally misunderstands what banks are here to do, that they're not here to create prosperity for small and previously impoverished communities. They're doing a number of other things, some of which you summarized just there, but of course, primarily making money and creating wealth for their stockholders and investors. But when I read that part there in particular, where you're describing these banks as financial holding companies, it sort of again recenters the focus on them from here to create wealth for poor communities to they're doing a whole lot of other things, including transferring investments to their subsidiaries, which are themselves investing in, so for instance, when you say that they're serving large investors like hedge funds and retail brokers, anyway, I'm just thinking, they're collecting investments, transferring those investments and investing them into subsidiaries that are themselves investing. In other words, so they're all trying to create wealth for each of these little segments that you're talking about that I think is interesting, that end up in some cases fighting each other within that umbrella. Anyway, so I don't know.
I mean, they're essentially huge corporations that are trying to make profits in lots of different ways. It's actually interesting if you look. I actually do this. Take an annual report of any of these banks from the last year. Which are these sort of glossy, publicity-friendly things. You will read a lot and see a lot of nice photographs about the things that the investment projects in poor areas, or this or that. I mean, they're very sensitive to this issue of publicizing money they put into investment projects that people would think as benefiting communities that are not already privileged. They maybe the annual report maybe doesn't emphasize in quite as much glowing detail. We're the number one prime broker for hedge funds that are making huge amounts of money, but they do so we're getting into the pros and cons of capitalism, which I've actually probably thought about less seriously than you or many other people have. But they're a business that makes money, and depending on what they do, you can think of various beneficial or neutral or harmful effects on society.
Yeah, well, I actually just wrote a note to ask you. It occurred to me I should ask you what you think of, because of course Richard Wolff is making use of your report to say capitalism is in crisis because it's constantly a mess and a crisis. It should be abolished. And I'm going to ask. I could ask you now if you want, but it just what do you think of his assessment of your work, or what would you prefer be the assessment of your criticism, if not as left as he is going with it, or I might go with it, for instance,
Well, I think certainly, a potential problem, or with market economies or capitalism or whatever words you want to use, are financial crises. 2008 is the most recent big example in the U.S., but around the world and over history, there are these financial crises, which lead to big recessions, a high unemployment, and lots of suffering, and so that is so I'm in that context. My paper is pointing out there's a risk of crises, and current regulations, which are designed to make sure that doesn't happen, are likely not to be as effective as is hoped. then sort of I think the center left response to that would be, oh, well, then we need somewhat stricter financial regulations in order to reduce this risk and make the economy function more smoothly. Other people might go farther and say this is an unfixable problem and we need some completely different system.
Yeah. And then they themselves would say, which is what I was also, thought to ask you about, is that at the end of the day, if they're from the I guess the opposing political pole would be kind of like what we saw this summer and in 2008. And correct me if I'm wrong, that if all else fails, we'll just create legislation that creates new money for us and bails us out, and then we'll sort of start all over again. But let me go ahead if you want to respond to that. But yeah.
Well, that's another whole. So that's actually, yeah. So this whole issue, I actually, this is a tangent we might or might not want to get onto. I actually personally don't really like the term bailout.
Okay.
I'm actually in maybe the narrow segment of economists and the general public who are pretty sympathetic to the idea of the government or the Federal Reserve helping banks if they're in trouble because of, it's like a lot of things. There's both sort of prevention and cure. That if this is actually people use the hokey analogy to fires. So okay, we don't want buildings to burn down. So all right, first of all, we want to have good fire codes and make sure people's electrical wiring is okay and people don't smoke in bed and try to prevent fires. And that's sort of what financial regulation is about, preventing. But then, inevitably there's going to be a fire sometimes. And then we also need the fire trucks to go, to go try to put out the fire. And I think that's, people talk a lot about we shouldn't bail out banks or rescue banks because that'll just encourage more bad behavior in the future. I think that's given how horrible the effects of crises are, on people around the world, it's a little bit like, stopping the fire truck on the way to a fire and say, oh, don't you're encouraging people to be sloppy about their electrical wiring. I think if a crisis is bad enough, you have to do something about it and then try to improve regulation in the future. But
yeah, I guess the only problem I might have with that analogy is that if the house that's on fire is also run by a group that is impoverishing and depressing and ripping off everybody else, then I could understand at least the logic of somebody saying to the fire truck, I don't care if you get there so fast. We like the idea of a fire truck, but we think you're going to the wrong house because that house maybe should be let to go ahead and burn down, and then you can maybe help us build up a better house somewhere else.
Although at the risk of them pushing the metaphor too far,
right.
Maybe we think, well, the people who actually live in that one house, maybe, it's their fault. It's okay if they burn down, but fires spread. There might be a lot of nice, innocent other people who live in the same block. And the trouble is they're going to get burned down too.
Well, that actually gets me to the last part that I wanted to read. I think it's a nice segue, actually, because you say here, quote, some of the large banks operate prime brokers that serve large investors, such as hedge funds. These customers deposit cash and securities with the prime brokers and may receive margin loans to help them buy the securities. Customers also borrow securities from their prime brokers to make short sales and post cash collateral. Some of the securities that prime brokers lend to customers belong to other customers. So, of course, on the one hand, the first thing I'm thinking of, again, this all sounds like a Ponzi scheme. but the other thing, if I'm understanding that correctly and understanding your analogy correctly, this is the point about the fire spreading that you're talking about. That these big banks are on, as we started off with, on a daily, if not even less or more frequent basis, lending to many others throughout the economy, who are lending to many others throughout the economy, who are lending back to others within that same
yes,
cycle.
and it's not all just rich bankers or hedge funds lending to each other. Again, there are
Right.
lots of spillovers to the rest of the economy. Again, we talked a little bit before about the different channels, and the example of the run on the money market funds, meaning businesses couldn't issue commercial paper and laid people off. But I mean, the bottom line is, the financial crisis of 2008 led to the Great Recession, and which was a terrible worldwide event, and millions and millions of people lost their jobs, lost their homes, had their lives badly damaged. So one could have an interesting debate about what we think about people running banks, and if they get in trouble, do they deserve it, or should we be sad about that or not? But practically speaking, basically financial crises lead to big recessions, and big recessions fall disproportionately on low-income, vulnerable people.
Yeah, I mean, that was really the point. Obviously, I wasn't trying to invite you here to have a broad ideological debate. It was really because I think, wherever we are on the ideological spectrum, there is, I think at least, a need to greater understand the specific functions of whatever it is, even if it is something we're looking to be critical of. And when it comes to banking, as someone who is more familiar with approaching this from the perspective of assessing the journalism about economic data, I think there's a lot of problems with how these issues are covered in the media and in the press, and even in some cases, again, across the political spectrum, especially when it comes to understanding, in this case, the nature of banks and how they function. And what it might mean, again. So I would want to just make sure we hit this point, if you haven't maybe re-summarize again why the biggest banks being in crisis is again, if I read correctly, you're suggesting that they are actually in crisis and it's just not being properly assessed as such.
Well, I think they're at risk of a crisis.
A risk of, okay, right.
So yeah, so it's again,
right. It's not that they're broke. It's just that they're riding that line. That
again, I don't know. Hokey analogies always come to my mind. If you're looking at nuclear power plants or something, there can be a situation in which, or any kind of occupational safety situation where nothing bad has happened yet, but there are practices that are going on which are not entirely safe, and there's a risk. So actually, I mean, the banking system is okay now, and actually the banking system has, in a way, done surprisingly well during the coronavirus crisis, and we could talk about that. So I think it's not that there's an immediate crisis. It's just there are some risky practices which, if things break wrong in the future, and again, this is the way it works. In the early 2000s, it looked like U.S. banks were very healthy and things were well regulated, and but then things took a wrong turn, and we suddenly had a big problem. So it's we're in a quiet period, I think, but there's more of a risk of future crises than we would like.
I would love to hear what you have to say about the banks doing well in this crisis. But if we can, I do want to acknowledge and especially appreciate a couple of questions here from one of our members, if you don't mind. Can you address the repo market issue that started with banks in 2019 requiring intervention, and have the 2020 stimulus efforts resolved that issue?
Okay, that sounds like
is that
Yeah, actually, keep that up there so I can read it.
Sure.
Okay, that's interesting. And so that sounds like a fairly well-informed question. So I'm not sure September 2019 specifically what happened then. I mean, there
I
was.
don't know.
I mean, there have been a variety. Yeah, there was something very strange in this past March at the beginning of the coronavirus crisis, when and here that this was. I don't really understand this well, but there was a problem with the market for Treasury securities, government bonds of everybody wanting to get cash and get rid of government bonds, and that caused interest rates to move in some crazy direction. And the Federal Reserve stepped in to provide lots of money and buy lots of bonds and stabilize things. The details are really technical, and I spent 4 years trying to understand 2008. I haven't yet quite gotten around to 2020, but broadly speaking, there are these sort of malfunctionings in markets, and the Federal Reserve can address that by basically putting lots of money in and buying assets that other people don't want to buy until things blow over. I think actually I think to go just to the question, I think the Federal Reserve has been quite successful in preventing the financial system from malfunctioning. I mean, obviously the Federal Reserve has not cured the virus, and the virus has shut down various businesses, and printing money can't cause people to be able to go to restaurants again. So the underlying economic problems. Basically, we need more of a fiscal stimulus, and of course, this has been in the news just the last couple of weeks. Should there be a $600 check or a $2,000 check, and do we need more unemployment insurance? But I might have lost track of the question. But those are some.
No, I mean it's again. That's I'll just put it up real quick again, and he's got a follow up too. Even to that, we have a very informed viewer here. But
okay, still okay. Oh my goodness. Yeah,
because that I know had a lot to do with what you looked at in 2008.
Yeah. Okay. So the short answer to that's an interesting question. If that person, my email address is easy to look up, or for that matter, or if you guess my email address, it's my first initial last name at jhu.edu. If that person wants to just send me an email, we can talk about it.
Okay. By the way, I should have even incorporated this from the beginning in my set of questions, but since the Federal Reserve was mentioned, what is the relationship between central banks and even these biggest banks, or even the difference between the two in terms of their relationship to the economy? Even maybe, I know it's a big, huge question, but even the question of the Federal Reserve not being federal. I mean,
well, okay, so it's a little bit complicated, but the basic, the Federal Reserve, I think, should be thought of essentially as part of the government. I mean, actually, technically, Federal Reserve banks are privately owned, and we could go into that, but really, you could think of it as part of the government, but an independent part of the government. Of course, this has been, and actually, there's a long tradition of the Federal Reserve being, so the Federal Reserve is not trying to make profits. It's sort of a government entity, but it's traditionally been run by technocrats who are independent of political influence. Of course, like a lot of things, sort of norms in this area have broken down a little bit in the last 4 years, which are thankfully, I think, coming to the end. I haven't read the news today about, but assuming we still have a democracy. But anyway, because Trump has tried very hard to influence the Federal Reserve, and has even and again, there are other areas where there's similar stories. He's threatened to fire the head of the Federal Reserve, which most people think he doesn't really have the legal authority to do, but there's a little bit of ambiguity. But in the past, and let's assume after January 20th, we can think of the Federal Reserve as a sort of independent entity, and it's charged with trying to stabilize the economy and keep inflation moderate, and also it's one of the main regulators of banks. So things like the liquidity coverage ratio regulation that I discussed in my paper, those are developed and enforced partly by the Federal Reserve. I mean, there are debates about whether the Federal Reserve, is, maybe too close to the financial community, sort of the usual debate in lots of regulatory areas about whether government regulators are too tied in with the industries they regulate, or that's a debate. But the Federal Reserve is supposed to be sort of an independent, apolitical government entity.
Mm-hmm, mm-hmm. Shout out to Craig here, but I think, yeah, right. GlassSteagall was supposed to prevent the problems Dr. Ball is describing. Securities activities together with commercial lending is always going to threaten bank capital requirements. Yeah. I don't know if you have a thought or a thought.
Actually, that's what I do have. So GlassSteagall was the traditional law from the 1930s, saying that commercial banking, meaning old-fashioned taking deposits and lending, had to be separated from sort of more speculative trading securities. The reason, I think this is worth dwelling on a little bit. I mean, the reason there's a firm called Morgan Stanley and a firm called J.P. Morgan Chase. They used to be, before the 1930s, they were both J.P. Morgan, and basically the banking part got separated off from the securities trading part. That was in 1999. That was basically reversed, and then that's what led sort of the sort of big universal banks like Citigroup and J.P. Morgan Chase. Those were made possible by the 1999 reform. I mean, to sort of get to the question, I'm sympathetic to the idea that there can be financial crises either way, but having these big institutions that do everything, does mean that problems in one area spill over to problems in other areas. And so I think so. So I'm somewhat sympathetic to the idea of bringing something back more towards like Glass-Steagall. Also, this goes a little beyond the question. Even the idea of, breaking up banks and just making them smaller, so that no one bank, the failure of no one bank can be quite as devastating as the huge banks now. I think that's an interesting area.
Well, I mean, but that was, I know this, again, this is off of our track here, but I know the concern, at least in some quarters, is that if they're too big to fail, they're too big to control and regulate or to manage. And that's, kind of, so so that's how I'll sort of put to you this sort of closing question that if from the perspective of people like me, that these big banks and through lobbyists or whatever else have so much influence over the political system and are in fact too big to fail and are too big to manage, when your analysis comes out, or certainly others that are far to your left, but even when your analysis comes out, what can be expected to be done so in other words, if you're ringing an alarm bell here of sorts, what would you like to see be done, or what could be expected to be done because again, if these big banks go, if the assumption is, that one doesn't want to see the whole thing collapse again, what would you like to see be done in response to the concern you're raising?
I think having some more stringent regulations. So, strengthening liquidity requirements to hold more cash, strengthening capital requirements, maybe something like the Glass-Steagall Act, or to separate out more and less risky parts of banking, broadly more regulation to try to curb overly risky behavior.
And it also seems like you're suggesting that something needs to be addressed in the methodology of the stress tests themselves, right? I mean, if I read at least what I tried to do when I was reading it, it looked like you were saying the formula might need to be adjusted here because these outcomes aren't.
Yes. I think yes, making some of the assessments of risk more realistic, which would then lead to requirements for holding more liquidity. Actually, I mean, you mentioned lobbying and that kind of thing, and I think maybe your listeners, there's a fascinating paper. This is now maybe 5 or 10 years old. If you Google, so this is from the International Monetary Fund, which is not famous as a leftist organization, especially, but it's about financial lobbying. If you Google it, it's something about Wall Street, Capitol Hill, and K Street. So what Wall Street and Capitol Hill, K Street is where the lobbyists in Washington are. And I think if you Google, one of the authors is Prachi Mishra, Mishra, first name Prachi. Prachi Mishra, Wall Street, K Street, Capitol Hill. Anyway, they have very, you're familiar with the idea that, lobbyists make campaign contributions and influence legislation, and so it's hard to regulate various industries, including banks. That they actually, it's really remarkable. They get data on specific contributions from banks to specific members of Congress, and then actually sort of map it into votes on financial regulation and changes in votes. So basically, if somebody has voted in favor of some regulation, what are the chances if they get X amount of money from bankers and campaign contributions that they will see the light and vote against regulations?
So it's like a lobbyist algorithm of some kind? Is it?
Well, it's sort of looking at data of sort of, trying to actually really quantify the effect of certain amounts of money in contributions on how members of Congress vote. And then also things like if you're lobbying, if you're a bank lobbying for legislation, it's according to this paper, it's a smart idea to hire people who used to work for members of Congress. That makes your lobbying efforts more effective. Anyway, so that's a big, so underlying all of this, the problem of the influence of money in politics, going back to the Citizens United decision, is a big issue in banking, and makes it a bit of an uphill climb sometimes to get strong regulation. Although again, there's more hope in the next 4 years than there, has been recently.
Well, Dr. Laurence Ball, I want to thank you very much for joining us. I really appreciate you taking the time. And just quickly to Renegade Pharaoh, appreciate your membership and support and questions. We're going to have to table some of this because I feel like, particularly with an open-ended question about Bretton Woods, will be here forever. And unfortunately, we just don't have the time to do all of that. And I did ask Professor Ball here for a very specific reason, so I don't, but I do appreciate your time and would appreciate being able to reach back out in the future. Now that we've made this connection, I'll be checking out your work and maybe asking you to come back and maybe for a discussion about Bretton Woods. I don't know. Anyway, no, but anyway, thank you very much. I appreciate you taking the time this
Thank
afternoon.
you. Yeah, and as you pointed out, we're neighbors, and even can dream of someday we could actually even meet in person.
Absolutely. if, at least theoretically, you're not far from us down the street there, and maybe one day we'll all be outside again. Anyway, anyway. Again, thank you, Dr. Ball. Appreciate your time. Take care. Thanks again for joining us.
Thank you.
And all right, everybody, thank you for joining us. And thanks to some of the new members. Really appreciate you joining, and to the vigorous conversation you all were looking to engage. And we'll have more of these conversations. I'll reach out to some more economists and maybe some specifically to deal with some of the questions you've all raised here. And we'll put some more information in the description related to this discussion there and at imixwhatilike.org. One of the questions was asking about signing up there. The subscription at imixwhatilike.org is just very simple. In at the top of the bottom of any page is something inviting an email. There's also a pop-up, an email subscription. The memberships here have the financial component, and obviously with some the fundraising that we hope to do for journalistic projects or supporting political prisoners, as explained in the highlighted video there at at this channel's page. So please do check that out and be in touch, and check the schedule at imixwhatilike.org as well, or at the channel for this at YouTube, because there's many more episodes coming up, including, if I'm not mistaken, we have tomorrow we have a big one with Aaron Mate, another Gray Zone collaborator, and then we are going to be talking about international reparations with Professor Araujo. I have to check on my pronunciation on that. So tomorrow we have a lot. We have Aaron Mate, Gray Zone at 12 Eastern, and then 5 o'clock Eastern time. We have, we have Professor Araujo from Howard University talking about international reparations movement. And then at 6 p.m. tomorrow Eastern time, we have Margaret Kimberly of Black Agenda Report. I got to get the promo out for that as well. So come on back tomorrow. Got a full day here at I Mix What I Like Live, and much more, of course, is happening at imixwhatilike.org. So thanks again, everybody. And as usual, to you, we say peace if you're willing to fight for it, like Fred Hampton. So peace, everybody, and we'll catch you next time.
I mix what I like.